Welcome everyone. Today we're going to talk about one of the most important aspects of trading, risk. Risk is an inherent part of trading and it can impact profitability in both positive and negative ways. In this presentation, we'll explore the different types of trading risks and how they can be managed effectively to enhance profitability. As traders, we all know that risk is something that we have to deal with every day. But do we really understand the different types of risks involved in trading? And more importantly, do we know how to manage those risks effectively? These are the questions we'll be answering today. Trading risk refers to the potential for financial loss resulting from market fluctuations, such as price changes or volatility. There are several types of trading risk, including market risk, credit risk, and liquidity risk. For example, market risk arises from changes in the value of investments due to factors such as economic conditions or geopolitical events. Credit risk, on the other hand, is the risk that a counterparty will default on a trade, while liquidity risk refers to the difficulty of buying or selling an asset without affecting its price. Effective risk control is essential for successful trading. By implementing risk control strategies, traders can minimize their exposure to potential losses and enhance their profitability. Case studies have shown that traders who use risk control strategies consistently outperform those who do not. One example of the benefits of risk control is the story of John Paulson, a hedge fund manager who famously made billions by betting against the subprime mortgage market in 2007. Paulson's success was due in part to his effective use of risk control strategies, which allowed him to limit his losses while maximizing his gains. Another example is the study conducted by the University of California, which found that diversification and other risk control strategies can significantly improve investment performance over the long term. One risk control strategy that can be employed in trading is diversification. This involves spreading your investments across different asset classes, sectors, and geographic regions to minimize the impact of any one investment's poor performance. By diversifying your portfolio, you can potentially reduce your overall risk and increase your chances of generating positive returns. Another risk control strategy is the use of stop-loss orders. These are orders placed with a broker to automatically sell a security if it reaches a certain price level. Stop-loss orders can help limit your losses in case a trade goes against you, but they also come with the risk of triggering prematurely if the market experiences sudden volatility. Hedging is another risk control strategy that involves taking a position in a security or derivative that is negatively correlated with another investment in your portfolio. For example, if you own stocks in a particular industry, you might hedge your exposure by buying put options on an index that tracks that industry. While hedging can help protect your portfolio from downside risk, it can also limit your potential upside gains. Implementing risk control strategies in trading is crucial to enhancing profitability. While there are a variety of strategies that can be employed, it's important to select the ones that best fit your trading style and risk appetite. One effective strategy is diversification, which involves spreading your investments across different assets or markets to minimize risk. Another strategy is using stop-loss orders, which automatically sell a security when it reaches a predetermined price level to limit losses. Additionally, hedging can be used to offset potential losses by taking an opposite position in a related asset. In conclusion, we have learned that trading risk is a crucial factor in enhancing profitability. By understanding the various types of trading risk and implementing effective risk control strategies such as diversification, stop-loss orders, and hedging, traders can mitigate potential losses and increase their chances of success. We cannot stress enough the importance of risk control in trading. As the saying goes, plan your trade and trade your plan. By implementing risk control measures, traders can stay disciplined and avoid making impulsive decisions that could lead to significant losses. We hope that this presentation has provided you with valuable insights and inspired you to take action in managing your trading risk. Thanks for watching. Like and subscribe and we will catch you on the next one. #study, #study skills, #accelerated learning, #study goals, #study motivation, #school, #mind mapping, #time management, #productivity. More study tips and resources. https://nas.io/pocketuni